Up in short order, and we'll take a look at what's opening and how many up and down. I mean, it's almost evenly balanced, right? In terms of neither here nor there, no directional push so far. And I think it reflects on the Nifty 50 heat map, almost 25 up and 25 down. Adani Ports, NTPC on one end, NTPC we just pointed out, and of course you've got a couple of life insurance and tech companies on the other side. Of course, IT's seen some reversal over the last 2 days or so. Surabhi.
Okay. Adani Ports, by the way, has also done a very small acquisition, one of their subsidiaries. Stocks up 1%, a little over 1% this morning. Looking at TCS next, CLSA believes TCS could be doing a 20,000 crore rupee buyback at some point, further down the road this year, following in Infosys' footsteps. Infosys itself, today is the board meeting. Stock is down about 1%. It's cooling off after its good run so far this week. Let's see what else is working in favor of the Nifty. Eternal, 1%. NTPC, the stock that we just discussed, 1%. ONGC is also up and about. And there's some buying that's returned to Mahindra and Mahindra, which is up 0.5%. But on the flip side, you actually have more of the IT names cooling off. It's not just Infosys. Even Wipro is slightly lower. Eicher Motors down slightly. And some of the bigger banking names like HDFC Bank and ICICI Bank are lower. Quarter to about 0.5% lower, keeping a lid on the gain. So the net result is very quiet, 11 points down on the Nifty. Nigel.
Well, from the broader markets, there are quite a few movers. And let's take a look at Tega Industries. They've gone to bite big. For the time being, the street has been pretty okay with it, actually. The stock is down, I think, only around 1.5% or thereabouts. They're looking at scaling up big time in the coming years. But, in the near term, that could be a bit of a debt worry. Though they're going to be on the roads and, in fact, trying to raise some equity. So I think 1% down is actually par for the course. One would have feared that it could be down far more. This is only initial rates. Let's see how it goes. For the time being, the stock is down 1.5%. Stocks that are doing well. Indocount, zooming away, massive volumes out there. That stock is bursting at the seam. Just take a look at that. Indocount, not Indo-Borax. I think we should get that one up for you on the screen. Jupiter Wagons, that's the other stock that's doing well. They've received a letter of acceptance from the Ministry of Railways and the Railway Board. Their value is approximately 113 crores odd. So that's why, in fact, that stock is up and about in today's trading session. Diffusion Engineers, that's the other stock, in fact, that's moving higher, I think. Let's pull that one. Recently listed company. That one is holding high with a gain of 3%. Volumes are rather large out there. Oracle, they have disclosed that, what's happening at the parent doesn't have any material bearing on our company. But the street, in fact, is reading it otherwise. Yesterday, it had a big run. Today, it's up another 3.5%. I'll tell you what. Yesterday, there was fresh buying. Today, the shorts could start scampering for cover, and that's why that stock is up 3.5%. MobiWick, another stock that's moved from 240 to 340 rupees. It corrected close to 5 to 8% in the last few trading sessions. Today, volumes are high on that one. So, flattish start on the headline index, but individual stocks doing a thing of their own. Prashant.
Absolutely. And, it's that kind of a day where you don't have very much by way of movement on the at a headline level. But yeah, I mean, stocks are a different story altogether. So we'll have more coming up in terms of individual movers. It's quite 17, 18 points in the Nifty, so just under 25,000 levels. And we're exactly at, a bit of a, I think we're at the moving average as well. So 24,980 or 24,990 is around where the 20 days sits as of yesterday's close. So you're exactly there. In terms of where the market needs to, what the market needs to sort of go above. All right, what else? More stocks in a bit, but let me also get in Harish Krishnan, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Great to have you with us here. Thank you very much for your time. I think we're talking for the first time since the GST cuts, Harish. So, it's a much debated topic in terms of how much a boost this will give to overall consumption, basically leaving a little bit more money in the hands of consumers, whether categories where the cuts are will see increase or, the money will find its way into other categories. So just that question, Harish, how have you and your team thought about this? You must have had discussions and has your approach changed in any way?
Yeah, I think clearly there has been a pivot from the government side to move into demand side stimulation. over the course of from 2018 to 2023 and 24, the focus of the government was clearly on supply side, investment, capex, PLI, etc. And there seems to be a material shift in that orientation. So that is the more important point to kind of look at, especially given how investment theme has done so well in the last 5 years and the consumption theme has underperformed over that same time frame. Most of the funds and portfolios are also significantly invested in that investment theme and underinvested in the consumption theme. So that has got market implications. Now, coming to the actual boost to the economy, apart from the sentiment perspective, I think it's a reasonably good boost, both from a function of the tax cuts that got announced in February, wherein, close to about anywhere between 75,000 to 1 lakh crore kind of potential savings would accrue to the top 15% of households, because those are the ones that actually do end up paying taxes. And this one covers the entire set of population, which would be, again, as per what the government itself has put in, a net benefit of anywhere between, say, close to about 50,000 crores. But that's the here and now. I think the bigger thing is, if these kind of things continue, I think it is going to lead to a lot more economic activity. Also, one of the key pushbacks of private investment has been the fact that demand has been a bit soft, and therefore there really is no real tearing hurry to kind of do investments, given the obsession that corporates have for ROEs. I think that also kind of changes a bit. So I think net, it's a very big positive, and it will require a significant change in portfolios. We've already kind of positioned for it. But I think market will start recognizing it more than the here and now of how the festive quarter, etc., kind of plays through, but more from a bigger perspective of how positioning and underinvested the overall space is.
Hi, Harish. Great to have you on the show. I was just looking at the consumption fund that you guys run, and it's fairly well diversified, right? I think it has representation from telecom, some banks like ICICI Bank as well, of course, names like M&M, ITC, so many more. So the question really is, how do you, can you effectively and efficiently also play consumption through the financials? Or is the direct route simply better? Go own the hotels, or own the airlines or the travel companies or the footwear makers? Or is the financial route a good route? And if that's the case, then what sort of financials? Because banks are very diversified. They have large, corporate books as well. And then you have a few names like Bajaj Finance on the retail side here and there. So just help us clarify the link, playing consumers through financial.
So this was the same argument, say, about 3-4 years ago, where that as the investment cycle comes through, you're going to see financials also being a way to play that same thing. And quite honestly, we haven't really seen that happen, more because they were over-owned at that point of time. Financials, were the go-to place for most funds, given the significant weightages they had in the index, etc. And they were significantly over-earning their profits from very high NIMs, very low credit costs, and the stocks just didn't perform. So therefore, to make that connection that now, here and now, consumption will start to fly and banks or lenders are going to benefit from that, I think possibly may not be, the argument that we really have. The argument for financials, of course, is that, you've got today an environment where, about the larger banks, about 4 or 5 large banks have got a significant access to capital. They're trading above book. Most of the rest of the private banking space is just about there. And therefore, in an economic environment where, competition is not coming through very significantly as far as the banking space is concerned, I think that the overall economic activity, which is to potentially double our economic size over the course of maybe the next 7, 8, or maybe 10 years, the banking system will do well. So I don't think it's necessarily just a play on consumption. It's a far bigger investment thesis, that of the supply side within the banking system actually being far more kind of in control and in check, given the regulatory environment that we have. And that's what makes us positive on the larger private sector banks in many of our.
All right, Harish, good to see you. And Harish, just hold on. I just want to focus on one stock. That's Oro Pharma. that one's bucking the trend. That's actually the high point of the day. As we speak, I think it's up close to around 4% or thereabouts. The news report that came in earlier said that GTCR is nearing a deal to buy the generic drug maker Zentiva. Remember, the street was a little bit cautious that Oro is looking to buy an entity that is too large. There was a fear of dilution, fear of debt in the books as well. So in that sense, the street could be viewing it as they are the lucky loser. So that's the reason why that stock is up. Harish, in the past, you've spoken about the diagnostic, set of companies. I think you all were quite bullish on there. How do you focus on, how do you play this? Pharma, till now, it's been protected from those kind of tariffs. The diagnostics, hospital chains as well, they are looking interesting. There's a longer runway, but your take, how do you approach healthcare?
So from a US generic piece, I think there are some significant one-off molecules that have boosted profit pools in the last 18, 24 months that are likely to go away. And that's almost, of the aggregate profit pool, close to about 15 to 20%. And therefore, as we look at the next 18 months or so, I would imagine that the profit growth in the pharma complex, especially focused on the US generics piece, is kind of going to be underwhelming. So we've kind of actually booked profits as far as the US generic piece is concerned. What we are kind of focused on, as you rightly pointed out, is on the diagnostic piece and the domestic pharma piece, where we do think that there are some interesting trends that we see. So coming to the diagnostic setup, COVID gave a leash of life for a lot of unorganized players, given the fact that there was an excessive focus of testing. And this brought in a lot of new competition. A lot of online platforms came in with significant price cuts, etc. And this, obviously impacted the pricing power of the incumbents as well as the potential for making profits. And therefore, we've seen their stocks being on the receiving end over the course of the last 3 years or so. Fast forward to 25 and 26, what we are seeing is that the competitive activity has kind of eased up. Even the aggregator platforms have actually started increasing their pricing as they have started focusing on their IPOs and their potential to create profitability from their significant loss pools that they're currently having. The third aspect is that, the incumbents are also focused on getting volume growth compared to just the margin expansion, which to our mind is the right strategy from a longer term perspective. And the fourth aspect is just the hypothesis that we have that, in India, we are going to see a fad or a significant kind of a move towards GLP-1. And given the fact that this is going to be at a very large base of population, we do think that there is going to be testing that is going to actually take off as doctors, physicians, as well as patients become a bit apprehensive in terms of potential side effects, if any. And therefore, that will also lead to a boost as far as demand is concerned. So this is our thesis as to why we think that diagnostics are reasonably well placed from an overall perspective over the course of the next 2-3 years.
Just I know that's very well put, Harish, and explained. Just a couple of more names, right? Oracle Financial Services is up, but it's the largest volume traded stock. Although I think I saw a flash from Oracle saying Oracle Finance saying that there's no real impact of what's happened in the US from Oracle and what Oracle has done. The Oracle stock parent was up 36%. Here, in terms of the business, there's no impact, but there's, I guess, some rub off. Jupiter Wagon is coming up as the second largest gainer now. Small name, but 8% on Jupiter Wagon. Indocount is another one, which is up 5.5%, 300 rupees. Third largest volume gainer on the NSE. There's Mostship, which is back up about 4% after, I think it took a break for 2 days on its way up, but it's coming back. And look at Tollens, which is Tollens Tires, 11% higher. I think it's a recent listing. 196 or so on this one, and it's within the top 10 volume-led gainers right now. Phase is something which Hormuz put out, and it's got volumes, but it's up 2%. Sigility is another one which is up about 4.5%, and so on and so forth. So lots of movers coming into the mix as we go through the motions. The first few minutes as far as market opening is concerned. Harish, just as we can sort of wrap up now, right? And it's, of course, as you said, it's going to get more and more, as the general belief is, we're getting selective from here. I know you're a close macro watcher as well, and currencies is something that you watch closely. I mean, look at what's, of course, happened to the rupee here. Any implications off of that as you look ahead?
So, from a release valve sort of thing, the government response to the tariffs that have come through from the US, which have been unfortunate and not clearly as per script, has been in terms of depreciating the currency. So the dollar itself is depreciated against most other currencies, and the Indian rupee is depreciated even against the dollar. In fact, against all trading partners calendar year till date, I think we've seen a fall of anywhere between 5% to 20%. So there has been a significant let-off as far as the currency is concerned. Now, this, to our mind, has implications actually on the IT sector.
I think we're losing the line.
Because the flowing down of revenue growth that they'll be growing at 2-4%.
Harish, go on. Please finish. I mean, I think we're losing the line towards the faggot. Go on.
Yeah. So while there has been this fear of revenue slowing down, but I think the greater fear that we had was, if the rupee were to appreciate close to about 80 because of the dollar weakness, then the margin leg for various IT services is actually in a very poor shape, and therefore there would be a further cut. I think with rupee where it is, I think that pressure of margins actually goes off. The revenue thing, like I said, expectations are quite low. It is an under-owned space. And I think, from a dark horse trade, while in the first 3 months we had private sector banks, metals and cement as the dark horse trades, now we do think that it is going to be IT services as a contrarian dark horse bet, as well as consumer, both in terms of consumer staples and consumer durables. That is where we are kind of incrementally allocating capital to kind of take into cognizance these kind of.
Okay. All right, Harish. We'll leave it on that note for today. Slightly a troublesome line as well, but we got the gist of it. Thank you so much for joining in with the perspective. Well, back to the screen. And the screen's very quiet, at least at the index level. Just about 9 points up on the Nifty as we speak. Mid-cap index is also fairly quiet. So it's always a good idea to look at individual stocks. And there are plenty movers in this morning's action as well. And Jupiter Wagons is definitely one of them. 7.5% higher. Let's bring in, Vinny back. Vinny, you had alerted us when we were doing our top stocks to watch. And Jupiter indeed is, rising high. Railway orders, right? They've got them from the railways. Yeah,
yes,
go on.
absolutely. They've received orders that is coming from the Western Central Railway side. And now this order is a big one. 113 crore order win is what is coming for the company. This is mainly for supply of 9,000 Fiat axles that are used mainly in the LHB coaches. Now, what does this do for the company? Because this company will further strengthen Jupiter Wagons' railway portfolio. And they've been steadily getting order wins as well in the recent times. So that's also a good sign coming in. And overall, we're seeing a bit of a decline in the stock in the recent times. So today we're seeing a bit of a up move because of that as well. And because of consistent order wins that the company has been getting over a period of time. That is interesting. Now, key will be to watch out for the execution, whether that's going to pick up now from Q2 onwards. Because still now we were seeing execution as an issue coming in for most of these railway companies. Execution is going to be the key. But today the order win is keeping the stock abuzz.
Okay, all right, Vinny, got it. Thank you very much. Actually, don't go anywhere because tell us more about Aurobindo as well. It seems that Aurobindo is out of the fray now in terms of this Zentiva acquisition.
Absolutely. Now, this is what we're picking up from Bloomberg as of now, that GTCR is nearing the deal to buy Zentiva. Now, Aurobindo Pharma, TPG, they were some of these top bidders for Zentiva as well. Now, likely, obviously, GTCR, if that comes into play, then they will be the ones that is buying Zentiva as of now. And seems like they have outbid Aurobindo Pharma as well as TPG as well. Now, previously, Aurobindo Pharma, what we had heard was in the lead for acquiring Zentiva, and that time we'd seen the stock see a fall coming in. Why? Because people were concerned that, this is a big acquisition, what would be the balance sheet of Aurobindo Pharma, and that is why that fall had come in the stock when the news had come in that Aurobindo was one of the likely bidders for that. And when Aurobindo Pharma's management spoke to us on 21st of August, they said that they were in talks with Zentiva, which were in early stages, but they highlighted that they are, going to be very mindful of any acquisition that they make, given that there are so many investor concerns coming in, that the company shouldn't be overpaying. So they were very mindful of that situation, and seems like now GTCR is the one that will be looking to buy Zentiva as of now, as per Bloomberg.
Lucky loser. Thanks a lot for that, Vinny, for joining and filling us in with a couple of stocks that are moving around. By the way, just keep an eye out Adani Power. The stock was down close to around 5%. I'll tell you what, there was a large trade that took place. That large trade got cleared out of the way, and the intraday chart comes up for you on the screen. The stock has recovered close to around 6.5–7% from the day's low. So just keep an eye out on that one. Very, very large trade is what we saw in the initial minutes of trade.
Absolutely. It was also in the news. It's, with, I think, MP Power, LOA, for supply of 800 megawatts of power. So that's on the business side, and then there's a block on the trading side that has just happened. For the time being, we are putting the spotlight on the financial space, and it's time to talk to the management of Chola. Mr. Arun Selvan, President and CFO at Cholamandalam Investments and Finance, is with us. Great to have you back on the show, sir. So, we want to focus on a couple of specific points. Let's just lay them out for our viewers. Number one, we want to understand how disbursements will perhaps shape up. Will there be improvement? Are your projections higher now for the year after the GST cuts? Of course, in the first quarter, we saw some hint of a little bit of a stress in vehicle finance. Let's find out if those trends are changing, if they're easing off. And then, of course, an outlook on the net interest margin. So, Mr. Selvan, good morning. Let's start with the first one, right? The GST bonanza coming through. But, in a very simplistic term, if I just break down the math, let's say if I was taking a loan from you for, 20 lakh rupees for a vehicle, now with the GST cut, maybe I need only a 15 lakh rupee loan. So, in an absolute sense, that's lower. But maybe demand will be higher. Maybe Nigel will say he also wants to, buy a new car. So, will higher demand offset the actual, reduction in prices? You've told us 20 to 25% growth, AUM growth this year. Will you be looking to increasing those estimates?
You are absolutely right that, there is a value reduction that will happen because of the GST being lower. There are two sides to this GST, reduction. One is the value, the overall, to answer your question, overall, in our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value, so overall, we don't want to change it either positively or negatively because of the GST reduction coming into play.
But sir, earlier you said a rough growth guidance of 20 to 25%. Now you're saying 20 to 22%. So is that a slight trimming?
Yeah. There will be, we need to be, I think we even moderated it to 23%. So 20 to 23% is the numbers which we are right now working towards. It will be predominantly driven by mortgage, and then there will be 18 or 20% growth on the vehicle finance. Mortgage should grow around 25 to 30%, which comprises of the LAP, HL, and the SBPL book, which we combinedly call it as the mortgage book. We had consciously taken call on reduction in the CSL business while we have articulated this. The fintech business has come down. And in the SME, we have slowed down on the supply chain. So these two are taking away some, growth from the disbursement side of it, while it will have very small impact on the AUM growth. So the AUM growth will remain, we still keep it at the 20 to 23%. That would be the level we are looking at for the full year. To just answer another part of the GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it.
All right. Hi, Mr. Selvan. Good to see you in. On Surbhi's point, Nigel is not looking to buy a car, but if in case I do approach your team, I've got very good credit worthiness, never defaulted. So the track record is clean. Got that. All right. Let's focus on the disbursements then. Earlier you were guiding, I think, for around 10–12% growth. Do you think ultimately that will come about? Because, quarter two has its own share of challenges, whether it's the floods, whether the economy is still a little bit weakish, and now you'll have, some kind of uncertainty with regard to the rollout of GST, apologies for that. The second half of the year, though, is expected to be far better. Do you think that 10–12% disbursement will be achievable?
Yes, see, you are right. It has always been a case that this Q2 will always be a slow quarter because of rains and also because it has got a fair share of the period coming under inauspicious months, etc. This is more so in the case of vehicle finance. So you will see impacting disbursement, but certainly we feel that. The disbursement would be better than first quarter across all the businesses, while it may not be significantly larger. AUM growth would be better. So as we have always been stressing that we look at AUM growth because that is the one which ultimately brings the interest income rather than the disbursement number per se. So AUM growth we still hold at the 20 to 22%. We should reach that number for the full year. And certainly the festival season and the good monsoons would augur well for the Q3 and Q4 numbers. That's the current sort of estimation that we run with.
Got that. Mr. Selvan, good morning. Prashant here. Just a quick point. Before, of course, I mean, this will help in many ways, GST. I mean, second order, third order derivative impact, etc. So it's all in the positive direction. But otherwise, across the industry, not for Chola. I mean, Chola is really at the top end of things in terms of growth, etc. But loan growth has been a bit of a problem. I mean, it's not panning out in numbers maybe yet, but feedback is that collections perhaps are taking a lot more effort across a range of financial companies, especially NBFCs. Is that true? And is there something which we will see over the next couple of quarters?
Yeah, it is true to some extent. I think that's the second part of your question, which was initially spoken about. Yes, there is a little bit of a higher stress on the collection, more so in the case of vehicle finance. But I think this again is a routine that we have seen earlier pre-COVID. During the COVID periods, we did not see this because the numbers were very high, and so it did not really show up. But we generally will have this cycle coming, like Q1, Q2 will always be a slower quarters. Q3, Q4 will be always a better quarter in the case of, especially in the case of vehicle finance. This sort of cyclical movement has started happening in vehicle finance post-COVID now that things have settled down. So you'll see that, panning out in this quarter as well as and improving in Q3 and Q4 when the festival season starts. This is primarily because the vehicle operators get more loads during the period of festivals and the harvest, which is when they will earn more and they will, be able to service the loan better. These are earn and pay type of customers, especially our customer profile. So there will be these sort of a slight fluctuations between the quarters.
My question was a little more broader, not the segment per se. I mean, if you rewind the clock, right? I mean, tightening by the RBI started sometime, I think, in late 2023, right? Risk weights went up, what banks lent to NBFC, and of course, what NBFCs further lent out. Then this MFI issue, trouble started sometime in middle of 2024, right? Q1, Q2 of 2024. That segment, especially the MFI segment, because it touches so many households. I think 7-8 crore borrowers. So the number of households it touches is enormous. The spillover of that, I mean, is that fully understood? I mean, the slowdown in that space, while that segment may see repair and recovery, and we talk about it from a stocks angle, but is that critical for reviving lending growth? There is a bit of a pause. And that needs to start again. That cycle needs to start again. Is that an issue?
See, both the MFI and the personal loan type of lending segment is based on unsecured lending, where there is no underlying security being offered by the borrower. So there is a tendency that these segments would grow faster when there is a lot of demand, and because this leads to sort of over leveraging by the customers. But in unsecured lending, ultimately the borrower has to bring a security to the table to take a loan. So in a secured lending, this becomes a little bit more organized or a little bit more controlled, that they have to find a security to start or to come and offer for a lending, whether it's gold, whether it is vehicle, whether it is mortgage. The second thing is, when you are lending to a business purpose rather for a consumption purpose or a discretionary spending purpose, then the responsibility that you see with the borrowers is much more significant compared to a discretionary borrower. Or a borrower, or a person borrowing for spending on a discretionary item, like buying a expensive bike or buying a consumer durable, which are not really up to his living standards. So this over leveraging tends to happen, especially like recently we're seeing a lot of people going on holidays, borrowing, which is, these things make them borrow and then get into trouble. So this is being what is getting curtailed with the recent actions of RBI, and this is where you are seeing this reduction happening. So the unsecured lending is where you will see more of these failures, and that's what we have also been slowing down on the unsecured side.
Sure. Speaking of unsecured, Mr. Selvan, just give us an overall picture on how asset quality and credit cost is moving, because in the first quarter there was some niggles over there and there was a slight rise in credit cost. If I have the right numbers for the full year, I think you're guiding for credit costs to be roughly 1.5%. So just tell us how the trends are shaping up in Q2 in across various segments, whether it is vehicle financing, LAP, etc.
Yeah, see, for the full year, the overall credit cost would be in the range of around 1.5 or even 1.6%, as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher. But going by the trend to now, and going, as I said earlier, the GST impact will also have a better or implication on the collection side, because the ability of the customers to pay becomes more is improved because of that lower burden on the EMIs. These things should start playing out, and that would have a positive impact. So we will be in the range of around 1.6% on the overall NCL level. With regard to unsecured, the increase you are seeing is primarily because we are not growing the book on the fintech. So when the growth is not happening and you are cleaning up the book, this generally tends to move up, and that's what we are experiencing.
Sir, on the credit cost, I mean, your exposure to the north is very less. But given that you are present slightly, could that add some more pressure, upward pressure to credit costs because of the massive flooding and disruption that we've seen?
Yes, it does in the segments like Punjab, Arunachal Pradesh, etc. But thankfully, in those particular states, our exposures have been minimal. But this is something which happens every year. Sometimes there's flood in Kerala, like there are years when there was floods in Kerala or in West Bengal or in. So, if you look at our geographical spread, we are not concentrated on any state where our share of volume is even in double digit, maybe other than Maharashtra. So to that extent, a system is built. That is the whole point of this diversification with regard to business, with regard to geography, with regard to customer profile. It helps us manage risk when certain pockets get impacted.
Got that. A very, very useful conversation. And Mr. Selvan, those holiday loans are real, sir? I just thought they were...
Oh, they are plenty, but we don't do that.
Loans for holidays?
Yes. It's a standard. You can get offers on the on any app.
I have to get leave first. Then I will All right. Thank you very much, Mr. Selvan. I appreciate you joining us, and important differentiation. And I think that's why you've done well with regards to some of the secured lending that you're doing. But yes, on the unsecured side, it is a bit of a problem. We'll take a quick commercial break here. We're going to come back with Anupam Rasayan management on the other side. Gopal Agarwal, CEO of the company, speaking with us on the company's export outlook and a lot more. Stay tuned.
Welcome back. Well, let's get to our next guest. We have Mr. Gopal Agarwal, the Chief Executive Officer at Anupam Rasaya in India, who joins us on the show. Hi, Mr. Agarwal. Thanks a lot for joining in, sir. Just coming to you. But we've got three big talking points that we want to discuss with Mr. Agarwal. One is the export market outlook. Second, the working capital improvement. And third, the commercials of various contracts as well is what we are looking at. So let's get straight to the point then. Mr. Agarwal, thanks a lot for coming on the show. Well, exports are approximately 58% of your order book, right?
Yeah.
A lot of it is coming in from the United States as well. Could you tell us first, what does this 50% tariff mean for you? And what are your customers, your clients telling you, post this imposition of these tariffs? Please go ahead.
So first of all, let me clarify, currently, I would say almost 60% of our export is to Europe. Another, I would say 20-25% is Japan. And as far as US is concerned, it was roughly, I would say more like 2-3% of our revenue, which is likely to grow to, let's say, 10% of the revenue this year. So from that perspective, it's not that US was a significant part of our exports. Having said that, honestly, we are not seeing, let's say much of a challenge. As far as the customers are concerned, they have continued, to ask us to kind of build on, let's say, the production. We have not heard from them, any kind of a disruption as such, wherein, they are wanting us to kind of, let's say, slow down the production or anything of that sort. That's number one. Two, as I said, for us, the exports is across Europe as well as Japan. And on those geographies, leaving, let's say, US for a moment out, is growing significantly. For the kind of contracts we have signed, currently, let's say, for example, my Japan revenue is roughly around 16-18%. With the contract in place, in 2 to 3 years, my Japan revenue could be easily 1/3 of my overall revenue. So from that perspective, we are pretty well diversified as far as our exports are concerned. So yes, would there be kind of a, let's say, some short-term impact of the tariff? The answer is yes. But I don't really see that should really impact not only us, but any of the chemical guys in the long run.
That's good clarification. So currently, US is extremely small, 2 to 3%, but you're saying that it could go to double digits. By when does that happen?
By the year end.
By the year end. All right. Got it. Let's move on then. Your order book, I think if I got that number correct, is around 14,600 crores. You have around 15 orders, out of which 11 are still letter of intents. Could you tell us when do these become final agreements? When do these contracts get commercialized? Some broad idea in terms of margins.
So thanks for asking this question. See, in our case, letter of intent is as good as a contract. The way it works is that before we get into signing a letter of intent, it's an effort of anywhere between 2 to 5 years, wherein the product goes through all the, what would you call, certification, let's say in case of agro registration, in different geographies. It passes through, let's say commercial test, pilot test, and all of that. So LOI for us, it's a more of a nomenclature, which is just kind of, let's say, at the fag end of a contract. And in fact, in some cases, we even start supplying commercially, on the basis of LOI itself. Number two, all of these LOI, given most of our customers are MNCs, it does require a board approval from their perspective. So, for all practical purposes, I would say these LOIs are as good as contract.
Can you give us some idea about your working capital? Because you have indicated that there's been a big increase in working capital. So from how many days to how many days? How long do you expect this to last? And what are the options available to try and kind of limit the impact?
So, Surabhi, I would say maybe a bit of a longer answer to this. Given the kind of a business we are into it, we are largely a B2B player, working with, I would say, the top-notch MNCs. And our contracts are basically long-term, which run anywhere between minimum of 5 to 7 years. Of course, we have had, situation where, some of our customers and product contracts have been running for maybe over 20 years or 30 years. So that's kind of one part of it. Given in most of our, let's say, contracts, we are either the primary or the exclusive supplier to our customer. So, while I may be supplying, let's say, a material or a molecule worth $10 to $20 million, to my customer, but his end molecule is maybe worth $1 billion. So, from that perspective, I become pretty, let's say, important, to ensure that the supply chain is kind of taken care, without which, his end molecule could be a bit of a challenge. and which is where, as part of the contract, we are expected to maintain anywhere between, let's say, a overall inventory of 5 to 6 months, given the criticality of the product. And, we need to have certain amount of stuff at our plant, certain at Indian ports, certain at foreign ports. So from that perspective, I would say for the kind of business we are into it, and given the kind of EBITDA margin, of anywhere between 24 to 26%, which we enjoy, we do have, let's say, a working capital cycle, which is 6 months. Having said that,
6 months.
Yeah, having said that, there were definitely a bit of I would say, headwinds, across globally, for the chemical companies and agrochemical in particular, in last, I would say, 6 to 7 quarters. So to that extent, one has definitely seen a much higher working capital kind of accumulating, for us. But if you would see, my Q1 numbers, very clearly, you have seen a significant jump in our revenue. I mean, our quarter, year-on-year revenue, my Q1 FY25 revenue grew almost 100% compared to the last
Absolutely.
year.
Absolutely. No, Mr. Agarwal, I understand it's the nature of your business. We're just trying to get an idea about the number. I'll come to the growth as well.
Yeah.
So just quantify this, given everything that's happening and the tariffs for now, they're here. But what is the visibility? How much will you grow your top line by this year? Can you retain margins at around 26%? And what will be the number of working capital days?
So as far as the growth is concerned, again, I think if you take out those 2 years, we as a company have grown at 25 to 30% CAGR, and we will continue to grow at that or even higher, given the kind of a contracts which we have signed, let's say, over last 2 years. That's number one. Two, as far as the margins are concerned, most of our contract, would have margin anywhere between that 22 to 26%. So from that perspective, I think we will maintain our EBITDA margin even going forward. As far as
you will maintain the margin, correct? And the revenue you said for this year?
For this year, as I said, I can't kind of guide you, but you have the Q1 number. If that is any indication, I can tell you. As I said, we are more than going to come back, to the glory days for sure.
All right. What about pharma revenues? They used to be at, I think, around 25 crores, or that scaled to around 75 crores. Could you tell us, is this LOI based, non-LOI based, and where do you see this number headed?
So pharma, our strategy, is very clear where, we are making what we call as KSM, key starting material. And this is basically an import substitute. And as far as the percentage is concerned, this year, my pharma revenue would be 20% of my overall revenue. So pharma has grown, I would say, very significantly for us compared to maybe, let's say, 4-5%. It's almost going to be 20% this year. And we do see, this number growing, let's say, both in terms of absolute and even in terms of percentage. So pharma has been definitely, I would say, one of the what we call good kicker, in terms of the growth for the current year as well as going forward.
Okay.
Yeah.
Yeah, Gopal, back to glory days. Look forward to it and look forward to our next conversation. Thank you very much. Good luck as you execute at Anupam Rasai. Thank you very much. I just want to make a quick mention of 2 names if we can. I know we have an important conversation, but pull up Indoco Remedies. Stock is shooting up 13-14%. I'm not sure if there's any news flow. That is Indoco. And the other one is Piccadilly. Piccadilly, huge volumes and stocks up 12.5% as we speak. So that is Indoco. And the other one is Piccadilly, which is the alcoholic beverage company, which is at about 717 at this point in time. All right, there you go. That's the one. The big conversation from the auto space, right? Let's now go across to the 65th SIAM conference for a CNBC-TV18 exclusive. Tarun Garg of Hyundai Motor India, my colleague Parikshit, waiting to interact with him. Parikshit, over to you.
Well, yes, the SIAM convention has kicked off in New Delhi. It's the annual gathering of top automobile leaders and thought leaders here in the capital. And with us is Hyundai's Chief Operating Officer and whole-time Director, Tarun Garg. Mr. Garg, thank you very much. Welcome to CNBC-TV18. We're kicking off the SIAM convention coverage with you. Let me begin by asking you about the GST cut and how is it immediately giving a positive impetus to sales, demand and bookings?
Parikshit, thank you very much for having me here. And at the outset, we at Hyundai Motor India Limited would like to really thank the Honorable Prime Minister for ushering in these huge GST reforms. We believe very strongly that these reforms are not only going to really give a huge impetus to the economy, But specifically talking about the automobile industry, very, very positive. You mentioned about the initial response. I think the response has been extremely good. There's a lot of enthusiasm in the entire chain, you know. Not only from dealers' perspective, the customers, the bookings. Last few days, the booking momentum has really gone up dramatically. And we are very happy because, as you know, the biggest festival of India, starting with Navratras, is just around the corner, and then followed by Diwali. Of course, the marriage season. I think these GST reforms have really come at the very, very right time.
All right. Could you give us a sense of the kind of growth that you're looking at in the festive season? I know it cannot be a month-to-month comparison, but overall, this festive season compared to last year, the growth?
So, Parikshit, if you see, the CAGR, 5-year CAGR for the Indian industry has been at about 4.5% to 5%. However, because of the geopolitical situation and whatever is happening around the world, we saw that this financial year, April to August, the industry is at about -2. I believe now there are about 7 months left in the year. I think kick-starting from September, hopefully we would achieve the CAGR growth, you know, so maybe this about 5%. So -2, the swing will be about 5%. So 7% swing from -2 to 5, I'm expecting going forward. September onwards, not only for this financial year, but going forward as well. Let me tell you, I have been in the industry for 32 years. At least last 20 years, never before such a big change has happened. So earlier, excise duty went down sometimes by 4%, 6%, at the max 8%. But this GST is 10% cut, you know, especially for less than 4-meter cars. I think it's absolutely fabulous, and I believe this will be a huge, huge impetus.
So expecting a 5% growth overall in the festive season and for the full visit?
Yes, I said for the period coming now. So September to March, probably we can look. Look, it's very difficult to really have a very exact number, but I believe that the swing from -2 to 5 is just around the corner.
All right. Now, in terms of surge in bookings, is there an actual surge that you're seeing both in rural and urban areas? And what would be the quantum of increase?
Yes. So there are 2-3 things which are happening here, in fact. One is rural, as it is last 2-3 years, was doing very well because of the infrastructure, because of the good monsoons, the minimum support price. So at Hyundai, the rural penetration had gone up from 19% to 23%. And also the SUV contribution in rural had gone equal to the urban contribution, you know. So we are seeing now, the good thing is last 2-3 days, it's too early to say, last 2-3 days, both rural and urban are showing a very positive uptick. Of course, customers are booking also in anticipation of the Navratras. As you know, Navratras are very big in West, in North, in Central. And also some of the customers who had withheld the purchases, like for Onam and all, are also coming out now and booking for the post-GST.
Okay. To speak to you about your growth in exports. Now, you are reporting double-digit growth in exports in FY26 so far. How do you see it for the rest of the year?
So I think this is a very, very important point, Parikshit. If you see, I would say that exports anyway, because of the situation in the domestic market and the macroeconomic situation, like I said, the industry was not really growing last few months in the domestic market, but we had an impetus on exports. We are very, very strong. We are outside of Korea, we are Hyundai's biggest base, especially for the emerging markets. We believe now it will be a double engine growth. So exports will continue to grow. You know, like I said, 12.5% growth already April to August. Going forward, we believe we have already given a guidance for about 9% for this year. Now that the domestic also starts coming into growth, this will be like a double engine growth for Hyundai. And to add to it, the new plant is around the corner. I think come October, we'll have the SOP of the Pune plant. We are all very excited because our capacity goes up from 824,000 in Chennai to now 170,000 more. So we are almost reaching close to 1 million. I think we could not have had a better timing for the Pune plant.
Right. Could you give us a sense of when will this Pune plant come on stream?
So like I said, Q3 of financial 25-26, the Pune plant will come on stream, and the phase 1 will have 170,000 capacity, which starts kicking in right from the first month.
Right. How do you see the GST changes changing consumer preferences in terms of buying cars? Because the EV cost differential has come down. Hybrids also will now be taxed at the same rate as ICE in small and large cars.
So look, there will be many things which will happen now. I think one is, if you see at the base of the pyramid, the car penetration in India is only about 34 per thousand. I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42, 43% in first-time buyers. So more small car selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity, because India is a very, very aspirational country, and again I think customers will want not only safety but connectivity. We are seeing a huge jump in the ADAS level 2. We are seeing that connectivity is going up. We are seeing sunroofs. We are seeing customers wanting the better stereo system, AVNT. So my point is that the aspirations will also come in. So this is the second part of it. The third part of it is, if you see, I think it's a very simple GST structure, no complications, no SAS. I think the opportunity is there for everybody to grab, whether it is petrol, CNG, whether it is, like you said, electrics. You mentioned that the gap is reducing between small cars, petrol and electric. But I would say, if you see the momentum of electrics, last couple of years, electric was somehow stagnant at 2.4%. But this year, if you see, in August, the penetration has already reached 6%. So this is a huge jump. I think the direction is very clear. Customers are really buying it, not only from a total cost of ownership point of view, but also from the commitment to environment point of view. And more charging infrastructure is coming up with the PM e-Drive scheme. And Hyundai also, if you see, whether it is the AC chargers, almost more than 950, DC chargers, 119, the big highways in India, we are going very aggressive. By 2032, we believe that the DC chargers will be upside of 600. So the entire ecosystem is going to support the EVs. We have already announced 26 new models, including upgrades by financial 30, which will have EVs, which will have hybrids as well. So I think the opportunity is there for anybody to grab. India is a very big market. Right. Every geography, every segment behaves differently. I think whether it is EVs, whether it is petrol, CNG, hybrids, everybody will have an opportunity.
So how much of your portfolio will now be in the 18% tax bracket? How much in the 40% tax bracket, and how much in 5%?
So that is $1 million question. As of now, we are 60% in the 18% bracket, and in terms of IC engines, and 40% in the 28% bracket. Let us see, because if you see last few years, customers are moving towards SUVs. But at the same time, I believe, and this is, I'll stick my neck out, I would say in the less than 10 lakh rupees segment, especially the extra segment, could see a huge growth, because that gives the customers the space, the SUV like body type, the ground clearance, the safety in terms of 6 airbags, the style, as well as the affordability. So I think I am really betting that segment will see a big growth, because that takes care of the price as well as aspiration. Right. And like I mentioned, going forward with our new product cycle coming in, I think we have across the range, we have huge opportunity, and we are going to really go for it.
All right. So would you say that sub 10 lakh is a segment you'll focus on aggressively?
I would say sub 10 lakh anyway is contributing 60% to our sales, and customers have been moving to more than 10 lakhs. If you see, plus customers have been moving to SUVs. I think what this GST cut will do is that SUVs in the less than 10 lakh segment will probably see a very big growth, and there is a huge opportunity there, especially if you are able to give the customers the right features in terms of connectivity, in terms of ADAS, in terms of sunroofs, in terms of automatics. I think this is one very big opportunity.
Okay, well, that's a very interesting conversation with the top management at Hyundai Motor. 2488 stocks absolutely flat right now. We'll slip into a quick commercial break here. On the other side, Somal Mehta will be with us of Mirai Asset Sharekhan for a quick technical check of things coming up. Okay, markets kind of come off and cooled off a little bit. We had a nice run off the lower end of the ranges. So today it's a little flattish and quiet. It's been that way from the morning. We have Somil Mehta of Mirae Asset Sharekhan who's with us now. Somil, good to have you with us. Thanks very much. So what's the plan from here in terms of trades? And let's start with indices. We'll talk about some stocks.
Hi, Prashant. Good to be here on your show. Overall, bias remains positive. We may just be in this range between 25,000, 25,200 is the upper end. Lower end would be 24,600, 24,500. So that's the range. We might just stay in this range. But the plan is that we should focus more on sector-specific, stock-specific action. There are a lot of sectors which are doing good. In the last couple of days, I think PSU banking has started doing well. Defense sector has started doing well. So I'm focusing more on those side. Stock-specific, pharma stocks are doing great. So the plan is to stay more stock-specific and not go into Nifty trading or bank Nifty trading because they are in a range. It's been in a range for a very long time, and the support and resistance everybody knows. So yes, at this time I think we may just take support around 24,800, 24,700, and again resume the uptrend. And I'll be expecting the previous swing highs to break on the upside, which is around 25,600, 25,700. So yes, positive on the markets. Nifty, bank Nifty, both buy on decline should be the strategy.
Yeah. Buy on decline should be the strategy. Stocks, Somil, what's on the radar?
Defense, that's the first thing I have in my radar. Muscat talk looks great. Small triangle pattern has broken on the upside, taken support at 200 daily moving average. Looks great. Stop loss should be 2720 and target would be 3000. That would be my first pick. The second one is Concor. Good momentum today. So Concor has broken out of a small consolidation on the upside, taken support at 20 daily moving average. Great setup. Stop loss should be 535 and target would be 590.
I think Sudarshan had a call on Mazgaon as well in the morning. So Mazgaon is one, and the other one is Container Corporation. So I'm going to get those trades from you, and of course that view as well. Appreciate it. So that's Somal with Mehta with perspective on markets. Let's talk about one name now, Eternal, where we want to just run you through some brokerage calls which are coming in. Hormuz is here with that. Hormuz, over to you.
Eternal doing well today. JP Morgan has raised its target on the stock and an outperform recommendation here, a 390 rupee target now for Eternal, implying around about a 20% upside from yesterday's closing levels. And they mentioned that the recent data channel checks that they have done is confirming the fact that Blinkit is expanding its leadership over peers in multiple ways, and they are also mentioning that they can sustain Blinkit can sustain the higher growth for a longer period of time, and this is without extending their break even or turning profitable timelines. And JP Morgan has also gone on to say that they will prioritize market growth over maximizing profits over the next 2 years, which is also evident from the kind of store expansions that Blinkit has done over the last couple of quarters, and as a result of which they have increased their quick commerce gross order value expectations for FY 26, 27 and 28 by 6%, 22% and 35% in that order, but the EBITDA estimates have been left largely unchanged. So positive commentary coming in from JP Morgan with regards to Blinkit raising their price target. The stock as a result doing well today.
Okay, all right. Got that, Hormuz. Thanks very much for the details. We will get into a very quick break after this and then connect with the management of MTAR Technologies. Yesterday, MTAR announced a number of orders, almost 400 crores of orders, which they'll get from Bloom Energy, which is a US-based big company in the clean energy segment. We'll find out more after the break. Welcome back. The next company on our radar is, excuse me, MTAR Technologies. We have Mr. Parvat Srinivas Reddy, MD at the company, joining in to take a couple of questions. And the company recently announced some fairly significant orders that they would be fulfilling for Bloom Energy, which of course is a company in the clean tech space. Bloom is a US entity. So the three talking points, we want to understand the scope of these new orders, the outlook on the rest of their businesses as well, which includes areas like nuclear science as well as defense, and the overall impact of US tariffs. Mr. Reddy, thank you so much for joining in. So let's start with these new orders, about 380 odd crores. You've had an ongoing, association with Bloom Energy in the past as well. I believe that these are components that you'll be supplying for things like hydrogen fuel cells. How large is this business for you? How much of this business, which is clean energy, how much is it contributing to your revenue now? And with these kind of orders coming in, what will be the contribution going forward? Just tell us everything. Margins on these orders, when do you deliver them, and when do you book it in the P&L?
The first thing is the orders what we announced is for the next calendar year. That's from January to June. In 6 months, we have to execute close to 400 crores worth of orders. I can't go into the specifics based on certain NDAs signed, but if you look at the overall picture compared to this year to next year, it's close to 100% of revenues, more revenues being generated only in the clean energy segment. That's the kind of demand what Bloom is looking for in terms of the order execution for next year. So it's almost like doing twice as much as what we're doing this year.
Absolutely, and it's very significant, sir, because if I look at your FY25 top line, you did 676 crores of revenue. Yes. And now you've booked orders worth almost 400 crores. So it's significant. These will be executed over what time frame? So just trying to understand whether it's more over FY26 or FY27.
It's, as I said, it's over 6 months period from January to June. And then you'll see a similar orders being coming in from July to December as well. So technically, you're looking at almost like 750 to 800 crores of orders, which have to be executed within a 12 months period of span.
So, sir, I mean, since the focus is really building on clean energy, I'm trying to understand the composition of your revenue pie. Will it then be predominantly clean tech, or will your defense business, space business, nuclear, will they keep pace? I'm just trying to understand the revenue mix, say, 12 months down the line.
Obviously, with 100% growth in clean energy segment, you can't expect similar growth in other segments, right? So we have been working on this segment for the last 10, 12 years. And I've been saying this all the time that the kind of development activity we have done, innovation we have done over the years, you are seeing the results now and even in the future. But not that we are doing extremely well in nuclear as well. We're expecting huge orders coming in from nuclear division as well. And that's something we are looking forward to because we have enough technology and capacity to handle that as well. So I think overall, if you look at it, the growth in clean energy segment is very rampant. But we also will have it cannot be as rampant as clean energy, but there will be a substantial growth in nuclear segment as well.
Nuclear is also clean, right? On a lighter note.
Yeah, on a lighter note, yes.
Sir, morning, Prashant here. You did what, 700 crores in revenues in 25, FY25?
Yeah, we did about 675 or 680.
Yeah, 676 or so. What is, say 2 years, so forget 26, 27, 28. What kind of numbers do you have in mind, sir, with all of this sort of coming together?
I mean, we should cross beyond 27, 28. We should be going beyond 1,500 to 1,600 crores very comfortably. The way we are looking at the kind of orders that we are getting and the kind of innovations that we have done, not only in clean energy segment, but also in nuclear and aerospace divisions as well. So we'll go close to that mark.
Yeah. So almost basically next 3 years, you're talking about not 3 actually, 2.5 now, half the year is done for 26. You're basically looking at almost 2.5 times growth.
Yeah, if you look at 27, 28, probably 1,500 crores is what we're looking at. So
yeah,
that's where we are looking at, right?
And margins would broadly be in this region?
Yeah, they would be broadly in this region, probably with a higher revenue growth that we're going to have. Obviously, for the current year, we said 25% would be the growth, but if you look at 26, 27, the growth would be much higher. I can't quantify it right now, it's too premature. But if you look at the kind of orders that we're getting, the important thing is these orders have to be executed within 6 months to 12 months period. Like, for example, in the case of clean energy, it's not like spread over 4 years, 5 years. So that itself is getting you a lot of operational leverage in terms of improved margins. So let's see how it goes. But overall, yes, we will be moving closer to that, crossing the 1,000 crore mark next year for sure.
Just one last question from my side. What's the on the nuclear front? I mean, we're one of the few countries which has been building reactors, right? The building plants, etc. And there's an ambitious plan. There's now SMRs, and you're already supplying to Nuclear Power Corporation, etc. Or you'll start now?
We're already supplying. We are executed some projects. We are doing it for the Gorakhpur project right now, the 700 megawatts. And Kaiga 5 and 6, we are in discussions right now.
And what exactly are you supplying, sir, here on the nuclear front?
It's completely the nuclear island. The most critical equipments for the nuclear reactor is what we specialize in, which is really very key to the entire nuclear reactor. We don't get involved in civil, but on the mechanical side.
What is that? I missed that. For the reactor?
For the entire nuclear island, the entire mechanical equipments, what is it?
Okay.
For the reactor, the coolant channel, the fuel handling assemblies. These are all very key to the whole reactors.
Yeah, some very, very nuanced engineering over there. Final question, sir. This order to Bloom, I mean, these are going to be supplies that go to the US, right? So just trying to understand, what is your total US exposure right now and what happens to tariffs? I mean, it's under what kind of tariff? Not sure if it gets excluded, or if you could just tell us.
It's not excluded. Nothing is excluded right now, right? So it all depends on the demand, what the US companies have and how to take care of that. So because it's on the technology side and the entry barriers are tough, the capacities have to be in place. These things don't take, doesn't happen overnight. It takes 3-4 years or 10 years for people to even think about this.
But the components that you will ship, they will, for now at least, they will attract 50% tariff, right?
They will attract 50% tariff. Yes.
Got it. But it's such a strong sign, right? If there are, if there is precision engineering, if products and services from India are top notch, then there is a demand. Where there's a demand, I mean, the products are going even at 50% tariff. Thank you so much, sir. Great conversation, and good luck to you, for all of those plans. Well, that's MTAR Tech, and as we have been speaking, take a look at what the stock has done. It started off from a flattish note, and now it's moving towards the higher points of the morning. Well, with that, it's time for us to wrap down this session of Bazaar. Thank you so much for being with us. Chartbusters comes up next.